Hi everyone, this is Professor Khushboo Chokshi and today we are going to discuss the 50 most important questions for your CA Inter-Corporate and Other Law paper. So we have covered the questions from all the different acts that is applicable for your examination, and in each of those acts we have also covered all the different concepts which are there and which may be asked in your examination. So starting with the first question. A group of individuals intended to form a club named Budding Pilots Flying Club as a limited liability company to impart classroom teaching and aircraft flight training to trainee pilots. It was decided to form a limited liability company for charitable purposes under Section 8 of the Companies Act for a period of 10 years, and thereafter the club will be dissolved and the surplus of assets over the liabilities will be distributed amongst the members as the usual procedure allowed under the Companies Act. Examine the feasibility of the proposal and advise the promoters considering the provisions of the Companies Act. So once you read the question, the first thing that should strike you is that we are talking about Section 8 of the Companies Act. Now, normally if a company has surplus profits, it is allowed to give that out as dividend to the shareholders of the company. But when it comes to Section 8, it is a little different from the other companies because it has a specific feature that it is formed for promoting charitable objects, and that any profit that it earns by promoting these charitable objects, it will not be distributed to the shareholders of the company. The profits have to be applied back by the company into its business for further promoting the charitable objects. That is what is told by Section 8. So when you are answering your question, how would you answer your practical case study type of question is that first you will mention what is the act telling you. If you know the section number, you mention the section number. If you don't remember the section number, you can just mention what the act is telling you because you would know that because you learned the concepts. Then secondly, in the second part of your answer, you will mention about the facts in the present case. So you don't have to copy that exactly from the question. You will have to mention things like that they want to form a company under Section 8 for charitable purpose, for the purpose of classroom teaching, and then they want to wind it up after 10 years and they want to distribute the surplus profits. And in the third part of the question, you will say how the act is applicable to the present facts of the case and what is the answer that you're trying to give to the examiner. So here you will say that Section 8 does not permit distributing the profits to its shareholders, and hence the contention of Budding Pilots Flying Club of dissolving the company and distributing the surplus to the shareholders of the company is not tenable, and hence they cannot go ahead with the plan as per the Companies Act 2013. Is that very clear? So quickly reading through what Section 8 is trying to tell us. Section 8(1) of the Companies Act, according to Section 8(1), whether it is provided to the satisfaction of central government. So central government is the central government is the one who is going to approve a Section 8 company. That a person or an association of persons proposed to be registered under this act as limited company has in its objects the promotion of commerce, arts, science, sports, education, research, social welfare, religion, charity, protection of environment, or any other such object, intends to apply its profits, if any, or other income in promoting its objects and prohibit the payment of dividend to its members. The central government may, by issue of license, allow that person or association of person to be registered as a limited liability company. In the instant case, the decision of the group of individuals to form a limited liability company for charitable purpose under Section 8 for a period of 10 years and thereafter to the company for thereafter to dissolve the club and distribute the surplus of assets over liabilities, if any, amongst the members will not hold good, since there is a restriction as pointed out in point number B above regarding application of its profits or other income only in promoting its objects. So here they are writing the facts. This is about the law, and here you will give your decision on the final applicability of law on the facts. So you will say that further there is a restriction in the application of surplus assets of such company in the event of winding up or dissolution as provided in subsection 9 of section 8 of the Companies Act. Therefore, the proposal is not feasible. So, what is this restriction? That it can either, the central government may ask the company to merge with another company, or it may say that, you will have to give the proceeds to a government fund. So it cannot give the funds back to the shareholders of the company. That is the restriction which is given in subsection 9 of section 8. Is that very, very clear? Now, coming to question number 2. The paid up share capital of Saras Private Limited is 1 Cr consisting of 8 lakh equity shares of rupees 10 each and fully paid up 2 lakhs cumulative preference shares of rupees 10 each fully paid up. So we will just write it down so that it's clear. So there is Saras Limited that you have. It has a So it has a paid up capital of 1 Cr and it has a equity share capital of 8 lakhs into 10 and preference share capital of 2 lakhs into 10. Okay. Now, Jeevan Private Limited and Sudhir Private Limited are holding 3 lakhs equity shares and 50,000 equity shares respectively in Saras. So we have Saras here. Who's holding shares in Saras? We have Jeevan and we have Sudhir. Okay. Now they are holding how many shares? They are holding 3 lakh rupees, 3 lakh equity shares of 10 each and 50,000 equity shares. Jeevan Private Limited and Sudhir Private Limited are subsidiaries of Piyush Private Limited. So Piyush Private Limited is the holding company for these two companies, correct? Holding for this company and this company, okay? With respect to the provisions of Companies Act, examine whether Saras Private Limited is a subsidiary of Piyush Private Limited. Would your answer be different if Piyush Private Limited had 8 out of 9 directors on the board of Saras Private Limited? So here we have to first analyze that what is the holding and subsidiary definition that is being given to you under the Act. So it says that you are a subsidiary of the holding company, or there is a holding company and you are a subsidiary of that company if there are 2 conditions you need to, not both the conditions, it's either or. So you can be a subsidiary if you control the composition of the board of directors or exercise or control more than 1/2 of the total share capital, total paid up share capital of the company. So if you comply with any of these 1 conditions, then you will be considered to be a subsidiary. In our example, Saras Private Limited has 8 lakh equity shares and Jeevan and Sudhir are holding 3 lakh and 50,000 equity shares. So it is less than half of the paid up capital and hence they will not be considered, Saras will not be considered as a subsidiary of Piyush Private Limited because it's holding less than half of the equity share capitals in Saras. Is that clear? Now the question is also asking that would your answer be different if Piyush Private Limited had 8 out of 9 directors on the board of Saras Private Limited. So here, if you think, the first condition of controls the composition of board of directors. If it has 8 out of 9 directors on the board of Saras Limited, it is controlling the composition of board of directors because it has 8 directors out of the total 9 directors. And in the second scenario, it will be said that it is a subsidiary of Piyush Private Limited. So first explaining the section, what is the section saying? That 287 of the Act, where they are defining what a subsidiary company is, they are saying that it's a subsidiary company if you control the composition of the board of directors, or it's either or you hold more than 1/2 of the total paid up share capital in the company. So in the first scenario, because it's holding what is 1/2 of the total paid up capital of Saras, it will be 4 lakh equity shares. But in this scenario, Jeevan and Sudhir, they are holding less than 4 lakh equity shares and hence they are not holding more than 1/2 and hence it will not be a subsidiary company. But in scenario number 2, it says that it is holding 8 out of 9 directors on the board of the company. Now, if it is holding 8 out of 9 directors, it is complying with the first condition, that is that you are holding the composition of the board of directors of the company, and hence if they are holding 8 out of 9 directors, then it will become a subsidiary of Piyush Private Limited. Okay, so that is how you will answer the case into 2 parts, giving the first answer and then the second answer for both the conditions that are given. Coming to the third question, a company issued a prospectus. All the statements contained therein were literally true. It also stated that the company had paid dividends for a number of years, but did not disclose the fact that dividends were not paid out of trading profits but out of capital profits. An allottee of shares want to avoid the contract on the ground that the prospectus was false in material particulars. Discuss whether he can do so. So here if you see, the question is covering concepts from 2 of your different chapters. One is about, it's asking you about the prospectus, and the second question, it's also checking your knowledge on the chapter based on dividends, wherein it said that how you can declare dividend as a company. So first thing, if you are issuing a prospectus, you are a public company, you are inviting funds from the public at large, and when you are issuing the prospectus, it is very essential that you disclose all the material facts in your prospectus before you actually invite the public to invest in your company. If the material facts are not disclosed in the prospectus, then a shareholder or an allottee can avoid the contract and say that this was based on not full disclosure of material facts. Now the second question here is that what is that is not disclosed. It is saying that the company has paid dividend, but the dividends were not paid out of trading profits but out of capital profits. So going to the dividend chapter, what does dividend say? That if you have to declare dividend, you have to declare your dividend out of your free reserves or security premium, but you cannot declare dividend out of your capital profits like revaluation reserve. So you cannot declare dividend out of capital profits, you can declare dividend out of trading profits. In some cases, declaring dividend out of capital profits is permitted, but if you declare dividend out of the capital profits, which is not a normal scenario, like not a normal thing for a company to do, if you do that, then when you are issuing the prospectus, it is a material fact and hence it has to be disclosed in your prospectus. So this is how we explain the act. Now we will say in the present case, the company has issued prospectus and the dividend paid out of trading profits and not capital profits is not disclosed. Hence in the present scenario, if the allottee wants to avoid the grounds on the grounds that the prospectus was false in material particulars, he can do so because declaring dividend out of capital profits and not trading profits is a material fact which has not been disclosed by the company in its prospectus. Quickly going through how the suggested answer would be. Just keep in mind that this is a suggested answer. You don't have to exactly write what's written here, but it should be something similar to what's written here. So you don't have to memorize this the way it is, but you can of course frame your answers in a similar pattern when you're writing in the examination. The non-disclosure of fact that dividends were paid out of capital profits is a concealment of material fact, as a company is normally required to distribute dividend only from trading or revenue profits and under exceptional circumstances can do so out of capital profits. Hence, a material misrepresentation has been made and hence in the given case, the allottee can avoid the contract for allotment of shares. Now coming to the fourth question, Mr. Akshat entered into an agreement for purchasing a commercial property in Delhi belonging to NRT Limited. At the time of registration, Mr. Akshat comes to know that the title deed of the company is not free and the company expresses its inability to get the title deed transferred in the name of Mr. Akshat, saying that he ought to have the knowledge of charges created on the property of the company. Examine with the help of notice of charge whether the contention of NRT Limited is correct. So this is testing our knowledge on the chapter of charges from your Companies Act. And what does it say? It says that a charge can be created on the assets of the company. So when a company is taking a loan, it can create a charge of any of its assets. And once a charge has been created on the assets of the company is required to intimate the charge to the registrar of companies, and the registrar will take it on record. And then once the registrar takes it on record, it is a matter of public notice, like anyone who is dealing with the company is assumed to have had a look at the charges which are registered with the assets which are registered as a charge with the registrar of companies. So here in this case, when Mr. Akshat has purchased a property, he is clearly not looked into the register of charges. He is not seen whether this property was under a charge, and he has gone ahead with the transaction. But the Act says that if you are dealing with any of the property of the company, and if that company has created a charge on that particular asset, as a buyer you are required to look at the register of charges, and it is assumed that before you are dealing with the company, you have looked at the register of charges, and only then you are going ahead with the transaction with the company. So if you do not look at the register of charges before dealing with the company or before buying the property of the company, then the company in no way will be responsible, because the register of a charge is a matter of public notice. So how will you answer the question? According to section 80 of the Companies Act, where any charge or any property on the assets of the company or any of its undertaking is registered under section 77 of the Companies Act, any person acquiring such property, assets, undertakings or part thereof, or any share or interest therein, shall be deemed to have notice of the charge from the date of such registration of charge. Thus, the section clarifies that if any person acquires a property asset which is already registered as a charge, it would be deemed that he has complete knowledge of the charge from the date the charge is registered. Thus, the contention of NRT Limited is correct, and Mr. Akshat can now not void the transaction. Okay. Now, coming to the fifth question. Tirupati Limited, a listed company, has made the following profits. The profit reflect eligible profits under the relevant section of the Companies Act. Here, for 12-13, it has made a profit of 20 crores, for 13-14 of 40 crores, for 14-15 of 30 crores, 15-16 70 crores, and 16-17 of 50 crores. So, Act is saying calculate the amount that the company has to spend towards CSR for the financial year 17-18. State the composition of CSR committee, unlisted company and a private company. So this is testing our knowledge on the concept of corporate social responsibility. As we all know that if you are a company which has a turnover of more than 50 crores, then you will have to follow with a corporate social responsibility procedure, wherein you will spend a certain percentage. In this case, we will spend 2% of the average net profits of the last 3 years towards any a social charitable activity. It will have to be spent by the company compulsorily once the turnover of 50 crores has been crossed. So, how will the amount to be spent towards CSR be calculated? When you have to calculate the amount, it says that you have to spend 2% of the average profits of the past 3 years, which will have to be spent in the current year. So, in this question, for Tirupati Limited, what is the average profit of the past 3 years? Which are the past 3 years? We are declaring in 17-18, correct? So the past 3 years are 1, 2 and 3. So 14-15, 15-16 and 16-17. What is the profit? It's the average profit, 30 plus 70 plus 50 divided by 3. So you have 150 divided by 3, which is equal to 50. So this is your average profit. Iska you will have to take 2% of this. that is the amount that you will have to spend towards the average net towards the CSR activities of the company. Now, for the CSR activities to be conducted, what do you need to have? You need to have a CSR committee. What does the CSR committee do? The CSR committee does nothing but basically advises the company as to which are the CSR activities where the company can invest in. What is the amount that will have to be contributed? So 2% is the minimum amount. It can spend more in the year if it wants to, but it cannot spend less than 2%. So it will suggest different activities where the companies can invest and basically guide the company pertaining to the CSR objectives of the company. Now, if you are a company, how is the CSR committee to be formed? You will need to have at least 3 directors to form a part of the CSR committee, out of which one will be an independent director. So, the Act says that you need to have at least 3 directors, 3 or more directors, out of which at least one director shall be an independent director. An unlisted company or a private company which is not required to appoint. If you are a company which does not require an independent director, then you can have a CSR committee without an independent director. In a private company, you need to have 2 directors on the board shall constitute CSR committee with 2 such directors. So for an unlisted company or a public company, you need to have at least 3 directors, out of which one will be an independent director. If your company is such that it does not require an independent director, then you can have only 3 directors. You don't need an independent director. But if you are a private company, you need to have only 2 directors for you to form a committee for CSR activities. So, composition will accordingly be, for unlisted company, 3 directors, out of which one is an independent director, and for a private company it will be 2 directors. Is that clear? Question number 6. As on 31st March 2018, the paid up share capital of S Limited is rupees 1 crores divided into 10 lakh equity shares of rupees 10 each. Of this, H Limited is holding 6 lakh equity shares and 4 lakh equity shares are held by others simultaneously. So we'll just write it down so that it's easier to understand. So you have S Limited here, which has a capital of 1 CR and has total shares of 10 lakhs. Now who's holding the shares? You have H Limited, which is holding 6 lakh shares, and others holding 4 lakh shares. Okay. Simultaneously, S Limited is holding 5% shares of H Limited. So it's holding 5% shares of H Limited, out of which 1% is held as the legal representative of a deceased member. On the basis of the given information, examine and answer the following queries with reference to the provision of the Companies Act. Can S Limited, which is your S Limited, make further investment in the equity shares of H Limited during the year 1819? Second question, can S Limited exercise voting rights at the annual general meeting of H Limited? And third question, can H Limited allot or transfer some of its shares to S Limited? So here, why is this question asked? So you have to remember that it has a paid up capital of 1 CR. H Limited is holding 6 lakh equity shares. When you see that number of 6 lakh compared to 10 lakh equity shares in H Limited, it should strike you that this is a question which is talking about the holding subsidiary relationship. So because it is holding, what is the requirement for a subsidiary company? 2 requirements under 287. What are those 2 requirements? That you have to control the composition of board of directors, or you have to hold more than 50% of the shares in the company. So because it's holding 6 lakh shares out of the 10 lakh shares, it's holding 60%, which is more than 50%, and hence S Limited has now become a subsidiary company of H Limited. And now understanding what are the questions asked. So can S Limited make further investment in equity shares of H Limited during 1819? So when we study about holding subsidiary relationship, what does the Act say? That you cannot, as a subsidiary company, acquire further shares of the holding company. But if you are already holding shares of the holding company before you became the subsidiary of the company, you can continue to hold those shares as it is. But once you are a subsidiary of the holding company, you cannot acquire further shares in the company. Correct? So in this case, S Limited can S Limited make further investment in equity shares of H Limited? It cannot make. It can continue to hold what it's holding, but it cannot make any further investment in the equity shares of the company. Coming to the question number 2, it says, can S Limited exercise voting rights at the annual general meeting of the holding company? The Act says that S Limited, even if it is continuing to hold, like the subsidiary company, even if it's continuing to hold the shares of the holding company, it can continue to do so, but it cannot vote at the meeting of the company unless the shares are held as a legal representative or as a trustee. In this case, S Limited is holding 5% shares, but out of that 1% shares are held as legal representative of the deceased member, and hence it can vote in the annual general meeting only to the extent of that 1% shares in H Limited, and not pertaining to the entire holding in H Limited. Coming to the third question, can H Limited allot or transfer some of its shares to S Limited? So what does the Act say? In the first question we discussed the same thing, that once they are holding the shares in the company, it cannot make any changes to the shares that are held in the holding company. So now once it has, if it's holding prior to the holding subsidiary relationship, it can continue to hold, but it cannot make any changes, and hence in this case H Limited cannot allot further shares to S Limited. Is that very clear? Going through what the Act is saying, what the suggested answer is saying. The paid up share capital is 1 CR. Out of this, 6 lakhs is held by H Limited. Hence, H Limited is the holding company of S Limited, and S Limited is the subsidiary of, S Limited is a subsidiary of H Limited, correct? Just a second. It's a subsidiary of H Limited. Now, answering point wise, like the question asked, as per the provisions of subsection 1, section 19 of the Companies Act says that no company shall either by itself or through its nominees hold any shares in the holding company, and therefore S Limited cannot make further investment in the shares of H Limited during the year 1819. Then for the second question, can it exercise voting rights? As per second proviso to section 19, a subsidiary company shall have a right to vote at the meeting of the holding company only in respect of the shares held by it as a legal representative or as a trustee. Therefore, S Limited can exercise voting rights only in respect of 1% shares held as legal representative of the deceased member of H Limited. Regarding the third question, can H Limited allot or transfer further shares to S Limited? Section 19 provides that no holding company shall allot or transfer shares to any of its subsidiary companies, and any such allotment or transfer shall be considered to be void. Therefore, H Limited cannot allot or transfer some of its shares to S Limited. Question 7. X Limited issued a notice on 1st Feb 2018 to its existing shareholders offering to purchase 1 extra share for every 5 shares held by them. The last date to accept the offer was 15th of Feb 2018 only. Mr. Kavi had given an application to renounce the shares offered to him in favor of Mr. Ravi, who is not a shareholder of the company. Examine the validity of the application of Mr. Ravi under the provisions of Companies Act. Would your answer be different if Mr. Kavi is a shareholder of X Limited? So here, what is the question asking you? It's testing your knowledge on the concept of rights issue of shares. What does rights issue of shares say? That when the company is doing a rights issue of shares, what it is doing basically is giving a right to the members of the existing shareholders of the company to purchase further shares of the company at a discounted price. Here, they have a window within which they have to, it's a right, it's not a compulsion. So it's a right whether you want to take the shares or you don't want to go ahead with the purchase of the shares. So here the right is given to purchase the shares, and if they want to purchase the shares, they have to purchase it within that prescribed period of time which is given. If the shareholder does not purchase it, then the company can dispose of the shares in a manner it deems fit. But when the right is given to the shareholder, if the articles of association of the company does not prohibit, then the shareholder can renounce the right in favor of some other person, which means that it can give the right to any other person, and that any other person can obtain the right shares which are being issued by the company. So, can it renounce the rights in favor of any other person? Yes, it can. Quickly going through what the provision is saying. Section 62 of the Companies Act, where any time a company having a share capital proposes to increase its subscribed capital by issue of further shares, such shares shall be offered to the person who at the date of offer are holders of equity shares of the company in proportion as nearly as circumstances admit to the paid up share capital of the company on those shares by sending a letter of offer subject to the following conditions. What are the conditions? The offer shall be made by notice specifying the number of shares offered and limiting time not being less than 15 days and not exceeding 30 days from the date of offer, within which the offer is, if not accepted, shall be deemed to have been declined. Unless the articles of the company provide otherwise, the offer aforesaid shall be deemed to include a right exercised by a person concerned to renounce the shares offered to him or any of them in favor of any other person, and the notice shall contain the statement of this right. After the expiry of the time specified in the notice aforesaid or on receipt of earlier intimation from the person to whom such notice is given that he declines to accept the shares, the board of directors may dispose them in a manner which is not disadvantageous to the shareholders and to the company. So this is what the act is saying. Now coming to the instant case, X Limited issued a notice on 1st Feb and the shares had to be purchased by him by 15th of Feb. So they've given a minimum 15 days of notice, which is fine. Mr. Kavi has not accepted the application and has renounced the shares in case name of Mr. Ravi, who is not a shareholder of the company. If nothing is specified in the articles of association, we see the point number 2 which we have discussed here. If nothing is specified, it is assumed that the offer shall include a right of renunciation. Hence, Mr. Kavi can renounce the shares offered to him in favor of Ravi, who is not a shareholder of the company. So, if article is restricted, you cannot renounce, but otherwise you can renounce it in favor of any other person, may or may not be the shareholder of the company. In the second part, it is asking if Mr. Ravi is a shareholder, then also it does not affect the right of renunciation by Mr. Kavi to Mr. Ravi. So you can renounce the shares in favor of any person. He may not be a shareholder of the company. If the articles of association specifically prohibit you from renouncing the shares, then you cannot renounce them. But if they don't prohibit, then you can renounce it. And if you do not renounce the shares in favor of any other person and you yourself do not accept it, then the company has the right to dispose it off in a manner it deems fit, but which should not be disadvantageous to your position. Question number 8. Ashish Limited, having a net worth of rupees 80 crores and turnover of rupees 30 crores, wants to accept deposit from a public other than its members. referring to the provisions of the Companies Act, state the conditions and the procedures to be followed by Ashish Limited for accepting deposits from its members. Now, it's a limited company, so it can accept deposits. But what does the topic of deposits, acceptance of deposit tell you? That if you want to accept deposits from the public, you need to have a minimum profit or net worth, of not less than 100 crores or a turnover of not less than 500 crore rupees. If you have your net worth of more than 100 crores or a turnover of more than 500 crores, only then and then you can accept deposits from the public. Otherwise, you cannot accept the deposits from the public. Now, in the present case, what is the situation? Ashish has a net worth of 80 crores and a turnover of 30 crores. Is it within the specified limit which is given by the Act? No, because what is the limit which is given? Net worth of 100 crores and a turnover of 500 crores or more. So it's far, from the limits which are given, and it's or. So even if the net worth is more than 100 crores but the profit is the turnover is 30 crores, even then it can accept, because the section uses the word or. So either the net worth is more than 100 crores or the turnover is more than 500 crores. Any one of the conditions you meet, you can accept the deposits from the public. But in the present case, since it's not meeting with the requirement of the deposit rules, it cannot go ahead with it. Also, going through the question, just want to mention that you will also have to write that if in exam you asked a question where the net worth is say more than 100 crores, then the company will also have to obtain the rating. So you will have to go to a credit rating agency and you will have to obtain a rating. Credit rating is nothing, basically saying that it's credit rating companies basically say that how good you are in repaying the credit or the loans that you have taken, and it will give you a ranking based on your performance, and based on that ranking people decide whether they want to invest in your company or it doesn't want to invest in your company. So if you cross that limit of 100 crores of turnover or more than 500 crores of 100 crores of net worth and more than 500 crores of turnover, then in addition to that you will also have to obtain the rating from a recognized credit rating agency. You have your CRISIL, CARE and other agencies which give you the credit rating. For informing the public, the rating given to the company at the time of invitation of deposits is basically giving you a rank as to how good the company is, so that the public can determine whether they want to invest in your company or they don't want to invest in your company, which ensures adequate safety, and the rating shall be obtained for every year during the tenure of the deposits. Provided further that the company accepting secured deposits from the public shall within 30 days of such acceptance create a charge on its assets of amount not less than the amount of deposit accepted in favor of the deposit holder in accordance with the rules. Since Ashish Limited has a net worth of 80 crores and a turnover of 30 crores, which is less than the prescribed limit, hence it cannot accept deposits from the public other than its members. If the company wants to accept deposit other than its members, it has to fulfill the eligibility criteria of net worth or of turnover, and only then it can accept the deposits. Coming to question number 9. Red Limited was incorporated on 1st April 2014, is facing severe effects of depression of the economy. Owing to its bad financial status, most of the members have started withdrawing their holdings from the company. The company had 250 members. It's a limited company. It has 250 members as on 10 Jan 2019. By 15 Jan, 244 members had withdrawn their holding. No new member has invested in the company after 15 Feb till date. Mr. A, an existing member, has approached you to advise him regarding his liabilities in such a situation. So here, first thing is that this is testing your basic knowledge about companies and how many members are required in the companies as per your section 3A. So you are a red limited. Red limited means you are a public company or not a private company. Now it's saying that it had 250 members and now 244 members have withdrawn their shareholding in the company. So 250 minus 244, how many members are left with the company? 6 members. As per 3A, how many members? This is a basic that you have learned like in foundation also. How many members are required to be there in a private company and a public company? In a private company 2, in a public company you need to have 7 members. But here you have 6 members. So your number of members have fallen below the prescribed limit which is required by the Act. Now what does section 3A say? That if your number of members fall below 7 which is required by the Act, and if you continue to if you continue to function as a limited company with the lesser number of members, that is less than 7 number of members, then in that case all the members who have the knowledge of the fact that the number has fallen below the prescribed limit of 7 will be personally liable for all the liabilities which are incurred by the company. So you have 6 months of time frame within which you are required to appoint all the 7 members. If the 7 members requirement is not fulfilled within the period of 6 months, then the company, all the members who are functioning as shareholders of the company with the less than the prescribed limit will be personally liable for all the liabilities. So here in this question they are asking, Mr. A, an existing member has approached you to advise him regarding his liability in situation. In this situation, since he is aware that the number of members have fallen below 7 and they have not taken any action to restore the minimum number of members, then Mr. A and all the other shareholders who have the knowledge of that fact will be personally liable. Reading through the suggested answer, what does it say? According to section 3 of the Companies Act, if at any time the number of members of company is reduced, in case of public company below 7, in case of a private company below 2. This is applicable to both public and private companies. So even if the question is about a private company, the same provision will be applicable. The company carries on business for more than 6 months while the number of members is so reduced, every person who is a member of the company during the time that it so carries on the business after those 6 months, so you have time till 6 months, but after 6 months also if you continue and is cognizant of the fact that it is carrying on business with less than 7 members or 2 members, as the case may be, shall be severally liable for the payment of whole debts of the company contracted during that time and may be severally sued thereafter. Is that clear? Hence, in the given situation, the number of members in the said public company have fallen below 7 and the members have continued beyond the specified limit of 6 months. The reduced members during the period of 1 month shall be severely liable for the payment of whole debts of the company contracted during their time and may be severally sued. Question number 10. CA is a partner in SMN Company Chartered Accountants and MLN Company Chartered Accountants. SMN Company are statutory auditors of Messrs Global Limited, which is a listed company, for the past 7 years as on 1st April 2018. Advice under the relevant provisions of the Companies Act. First question is, for how many more years SMN Company can continue as statutory auditors of Messrs Global Limited? Can ML Company be appointed as a statutory auditor of MS Global Limited during the cooling off period of SMN Company? So auditors, we are testing the knowledge on auditors. What does the section say? That if you are a firm of chartered accountants, you can be a statutory auditor in a company for a total period of 10 years. So 2 consecutive appointments of 5 years each. You can be a statutory auditor for a period of 10 years. Now here in this case, SMN Company has already been a shareholder for the past 7 years. So here 7 years are already done. So how many further number of years can he be the statutory auditor? For a further period of 3 years. So in the first question, can continue as statutory auditor of the company for a further period of 3 years. Can ML company be appointed as statutory auditors during the cooling off period? So after you finish the period of 10 years, you need to have a cooling off period of 5 years for which you will not be appointed as a statutory auditor. So now in this case, ML company wants to be appointed as statutory auditor, but since the CA Mr. M is a partner in both the firms, the new company, that is the ML company, can also not be appointed as a statutory auditor. If they don't have the common partner Mr. M, then that company can be appointed in the cooling off period, but because they share the common partner, he cannot, ML company cannot be appointed as a statutory auditor in the cooling off period. Quickly going through the suggested answer. As per section 139, read with relevant rule 6 of the company's audit and auditors rule, in case of an auditor, whether individual or audit firm, the period for which the individual or firm has held office as auditor prior to the commencement of the act shall be taken into account for calculating the period of 5 consecutive years for individual and 10 consecutive years for the audit firm, as the case may be. As the stated facts, SM and company are statutory auditors of Messrs Global Limited. Since it's a firm, it has 10 years. For the past 7 years, on 1st April, accordingly, SM and company can continue as statutory auditors for 3 more years. And ML and company, since they share the common partner, cannot be appointed as a statutory auditor in the cooling off period. Coming to question number 11. Mr. Ram, brother of CA Shyam, a practicing chartered accountant, acquired securities of Messrs School Limited having market value of rupees 1,20,000, face value of rupees 95,000. State whether CA Shyam is qualified to be appointed as the statutory auditor of Messrs School Limited. Now, what does the Act say about a statutory auditor being appointed and regarding the holding of shares by the auditor or by the relative of the auditor in the company? So, the Act says that if you are being appointed as a statutory auditor, if your relatives are holding shares in that company, they can hold shares in that company to the extent of face value of rupees 1 lakh and not more than that. Only then you can be appointed as a statutory auditor of the company. Here it is very, very important to remember that while calculating that how many shares are held, what is the figure that you have to take into consideration, you have to take into consideration the face value of shares. The question will always give you the market value of shares to confuse you, but you don't have to look at the market value. The market value keeps on fluctuating. Someday it may be less than 95,000, someday it may be more than 1,50,000, and that is irrelevant. Market value, you always have to remember, is irrelevant while calculating whether the statutory auditor can be appointed or not. What is important is you have to consider the face value of the shares held by the relatives of the of the auditor. Here in this case, the relative of auditor is holding face value worth rupees 95,000. What is the limit that is being given under the Act? The Act says that the relative of the auditor can hold shares up to face value of rupees 1 lakh. Here, since he is holding 95,000, which is less than the prescribed limit of 1 lakh, Mr. Shyam can be appointed as the auditor of the company. Quickly going through the suggested answer. As per provision of section 141(3)(d) of the Companies Act, a person who or his relative or partner is holding any security or interest in the company or its subsidiary or its holding or associate company or a subsidiary of such holding company anywhere, such company shall not be appointed as an auditor of the company. However, the proviso of the said section states that the above restriction will not apply where such relative holds security or interest in any of the companies with a face value not exceeding rupees 1 lakh. Please always remember, the question will always give you the market value to confuse you. You don't have to look at the market value. Always remember, the market value keeps on fluctuating, so you can't keep on removing and adding the statutory auditor, right? That is the logic. Hence, you always have to look at the face value and you do not have to look at the market value. In the given case, CA Sham is not disqualified to be appointed as statutory auditor in Messrs School due to the fact that the value of the securities held by his brother, who is a relative, is of face value of rupees 95,000, which is within the prescribed limit. Coming to question number 12, Veena Limited held its annual general meeting on September 15, 2018. The meeting was presided over by Mr. Mohan Rao, the chairman of the company's board of directors. On September 17, Mr. Mohan Rao, the chairman, without signing the minutes of the meeting, left India to look after his father, who fell sick in London. Referring to the Veena Limited referring to the provisions of the Companies Act, state the manner in which the minutes of the above meeting are to be signed in absence of Mr. Mohan Rao, and by whom. I think the same part is repeated, so you can just ignore and go to that part. So here we are testing your knowledge on the minutes of the meeting. What is minutes of the meeting? It's basically recording everything that has happened during the meeting and then making a minutes so that it is kept for future reference. Who is responsible for doing that? The chairman of the company, the chairman of the the meeting, who is appointed as the chairman of the meeting, will be responsible for recording the minutes of the company. Now, within how many days from the date of end of the meeting, this minutes have to be recorded and submitted with the registrar of the companies? Then it has to be recorded within a period of 30 days from the end of the meeting. So here, what has happened is that the annual general meeting was held on 15th of September and the chairman of the meeting has to sign it. But Mr. Mohan Rao on 17th of September had to leave the country for whatever reason of father who fell sick. So he had to leave the country and now he is not able to sign the minutes of the meeting. But the Act says that the chairman has to sign the minutes of the meeting. The Act also says that if the chairman of the meeting is not present for signing for whatever reasons, if he is not present, then the minutes of the meeting will have to be submitted within a period of 30 days, but it will be signed by a director who has been appointed by the board of directors to sign the minutes of the meeting. So if he is leaving, Mr. Mohan Rao had to leave and he could not sign the minutes of the meeting, then the board of director will appoint another person or another director who will sign the minutes of the meeting, and those signed minutes will be submitted with the registrar of companies. So quickly going through the suggested answer, section 118 of the Companies Act provides that every company shall prepare, sign and keep minutes of proceedings of every annual general meeting, including the meeting called by the requisitionist and all proceedings of meeting of any class of shareholders. So not only the annual general meeting, but even if a EGM is called by the requisitionist, even that will be considered. Or if any class meeting is held, like of preference shareholders or debenture, if any specific class meetings are held, even those minutes will have to be signed and preserved by the board of or board of directors or committee of the board, any meeting by the creditors or the board of directors, and also resolution passed by postal ballot within 30 days of conclusion of every such meeting concerned. Minutes shall be kept as evidence of the proceedings recorded in the meeting. Now, by virtue of Rule 25 of the company's management and administration rules, read with section 118, each page of every such book shall be initialed or signed, and the last page of the records of the proceedings of each meeting or each report in such book shall be dated and signed by, in case of minutes or proceedings of a general meeting, by the chairman of the same meeting within the aforesaid period of 30 days or in the event of death or inability of that chairman. In this case he has left, but in case even if he dies and he is not able to do that, within that period a director duly authorized by the board for the purpose. So who will sign it if the chairman is not there? It will be signed by the director duly authorized by the board for that purpose. Therefore, the minutes of the meeting referred to in case of Veena Limited can be signed in absence of Mr. Mohan Rao by any director authorized by the board in this respect. Is it clear? Coming to question number 13, state with reasons whether the following statements are true or false. This can be asked in your examination. Each will be like for 1 mark, and they'll test your knowledge about the smaller provisions which are provided in the Act. So coming to the first question, ABC Private Limited may accept deposits from its members to the extent of rupees 50 lakhs if the aggregate of its paid up capital, free reserves and securities premium amount is rupees 50 lakhs. So here it's about acceptance of deposits from its members. So first you have to see what kind of a company is it. It's a private limited company. Now what does the Act regarding deposit tell you? That if you are a public company, then the limits are different. If you are a private limited company, the limits are different. If you are a public company, then you can accept deposits from members to the extent of 35% of your paid up capital, free reserves and securities premium. But if you are a private limited company, you can accept deposits up to 100% of your paid up capital, free reserves and securities premium. In this case, it's saying that it's a private limited company. Capital, paid up capital, free reserves and securities premium amounts to 50 lakhs. 100% of 50 lakhs is 50 lakhs, and hence the deposit from members up to 50 lakhs can be accepted and the statement is true. A government company, point number 2, government company which is eligible to accept deposits under section 76 of the Companies Act cannot accept deposits from the public exceeding 25% of the aggregate paid up capital, free reserves and securities premium account. So how you have a limit for private company, public company, you also have a limit for government companies. For government companies, what is the limit that's given for acceptance of deposits? It's 35% of paid up capital, free reserves and securities premium. This statement is saying it cannot accept more than 25% of the paid up capital, and hence the statement is false, because a government company can accept up to 35% of the paid up capital, free reserves and securities premium account. So this is false. Then point number C, the registrar of companies is not bound to issue notice to the holder of charge if the company gives intimation of satisfaction of charge in the specified form and signed by the holder of the charge. So here we are talking about the topic of charges. What does the topic of charges say? That if you are creating a charge on the assets of the company, as a company you will have to intimate the registrar of companies. If you do not intimate as the holder of the charge, then the person in whose favor the charge is being created will have to intimate the registrar of companies. Similarly, when the charge is satisfied, that is when you have repaid the debt and there is no longer a charge on the asset, that is called satisfaction of charge. So when the satisfaction of charge is done, then you will have to intimate the registrar that the satisfaction of charge is done. But only because you as a company are saying that the satisfaction of charge is done, the registrar will not take into account the satisfaction of charge. It will ask the holder of the charge whether actually this charge has been satisfied or not. It will take a confirmation from the holder of the charge and only then record the satisfaction of the charge. But this line is saying that it has the satisfaction of charge has happened and it is also signed by the holder of the charge. So if the holder of the charge has already signed it, then the registrar need not take further confirmation saying whether the satisfaction is done. He has already signed it. So it is proved that the satisfaction of charge has been done. So the registrar is not bound to issue notice if the specified form is signed by the holder of the charge. The statement is true, because the confirmation which it wanted to take has already been received because he has signed the form, and hence the registrar will not have to take any further confirmation. Next question. The Registrar of Companies may allow the company or holder of the charge to file intimation within a period of 300 days of the satisfaction of charge on the payment of fees and additional fees as may be prescribed. So if you go back and understand within what time you have to register the charge, there are two provisions. One is before 2nd October 2018 and one is after 2nd October 2018. Before 2nd October 18, you had to register charge within 300 days. If not, within first 30 days. If not done, the registrar will give you further period of 300 days to register your charge. But after 2nd October 18, if you are, if you have created a charge, you will have to register within a period of 30 days. If not done within 30 days, it will give you further period of 60 days to register your charge. So that is the provision. So this statement which is made that it is done within a period of 300 days, and since no date is given, we will say that the statement is true. Coming to question number 14. The income tax authorities in the current financial year 1920 observed during the assessment proceedings a need to reopen the books, the accounts of Chetan Limited for the financial year 8-9, and therefore filed an application before the National Company Law Board Tribunal to issue the order to Chetan Limited for reopening of its accounts and recasting the financial statements for the financial year 8-9. Examine the validity of application filed by the income tax authorities to NCLT. So, income tax authorities has the right to file an application to NCLT if they want to reopen the accounts. Other authorities like SEBI and ROC can also file if they feel that there is a need to reopen the accounts. But the Act gives you a time limit within which these authorities can file an application for reopening of accounts. What is the time limit? Under the Income Tax Act also we have studied the same thing, and here also in Companies Act we have studied the same thing, that if you want to reopen the accounts, the reopening of accounts has to be done within a period of 8 years from the end of the financial year. If the accounts are not reopened for a period of 8 years from the end of the financial year, then these authorities do not have any right, and no matter where they make the application, they cannot reopen the account since the 8 years have expired. In this case, 8-9 is the year which has been reopened. You have a period of 8 years from the end of the financial year to reopen the accounts. We are talking about the year 18-19. So 8 years is 16-17, but we are already in 19-20. So 8 years have already expired. And now in 19-20, even though the application to NCLT is a correct application, but it cannot reopen the accounts because the period of 8 years from the end of financial year has expired. Quickly looking through the suggested answer. As per section 130 of the Companies Act, a company shall not reopen its books or accounts or not recast its financial statement unless an application in this regard is made by the central government, income tax authority, SEBI, or any other statutory body or authority, or any person concerned, and an order is made by a court of competent jurisdiction or the tribunal to that effect. The relevant earlier accounts were prepared in a fraudulent manner, or what is the application to be made? That it's made in a fraudulent manner, or the affairs of the company were mismanaged during the relevant period, casting a doubt on the reliability of the financial statement. So any of these authorities can make an application to the tribunal saying that this is the reason why we are opening it. However, no order shall be made in respect of reopening of books of accounts relating to a period earlier than 8 financial years immediately preceding the current financial year. In the given case, the application for reopening and recasting has been made for the financial year 8-9. Though an application filed by the income tax authorities to NCLT is valid, which is income tax authority can make an application to NCLT, its recommendation of reopening and recasting of financial statements for a period earlier than 8 financial years immediately preceding the current financial year, that is 2019-20, is invalid. It cannot open since 8 years have already expired. Question number 15. The Board of Directors of A Limited requested its statutory auditor to accept the assignment of designing and implementation of suitable financial information system to strengthen the internal control mechanism of the company. However, how will you approach this proposal as a statutory auditor of A Limited, taking into account the consequences, if any, accepting the proposal? So here, if you are a statutory auditor of the company, why are you appointed as a statutory auditor of the company? So that you can see the working of the company as an outsider. You can figure out what are the issues within the company, report that back to the management of the company, and ensuring that the systems are well maintained and that there is no fraud. So that is your responsibility. You are independent of the company. You are not involved in the affairs of the company. Whatever you are looking as an auditor of the company, you are doing it independently and then reporting to the government and of course reporting to the company. Now, this is saying that they want to appoint a statutory auditor for implementing and designing financial information system. Now, if the financial information system is done by the statutory auditor himself, then there will be no independence which will be there with the statutory auditor, and hence the act prohibits the statutory auditor from doing any designing and implementation of the financial information of the company of which it is a statutory auditor. Going through the suggested answer. According to section 144 of the Companies Act, an auditor appointed under this act shall provide to the company only such other services as are approved by the board of directors or the audit committee. But such service shall not include designing and implementing of the financial information system. In the said case, the board of directors requested its statutory auditor to accept the assignment of designing and implementing of suitable financial information. As per the above provision, the said service is strictly prohibited, because then the auditor is losing all the independence, which is why he is appointed as statutory auditor, correct? In case statutory accepts the assignment, he will attract the penal provision specified under section 147 of the Act, and in the light of the above provisions, we advise the statutory auditors not to take up the above assignment.